Good evening and welcome. My colleagues and I are dedicated to serving the American people. We do this by pursuing full employment and stable prices. We make the best decisions we can based on facts and objective analysis. Today, we decided to lower interest rates and lower interest rates paid on excess reserves. As we will explain shortly, we took this step to help keep the United States economy strong in the face of some notable developments and provide insurance against ongoing risks. The U.S. economy has continued to exhibit robust growth, even in the 11th year of this expansion. So Simon, will you take us through the numbers of our gross domestic product?
Absolutely, Joe. So first, let's take a look at the GDP growth, where we see a moderate increase from the second quarter, which, as we believe, is mainly driven by the strong consumption of durable and non-durable goods. When looking at the durables, we see a steady increase from the first quarter of 2019, and the same applies for non-durables. When looking at the household consumption, we see a solid increase, which is represented by stable demand for goods and services. Considering the data, it is safe to say that the household consumption has been driving our economy in the past years. Next, we look at investment as the next major component of GDP, and we see an opposite of what we saw with consumption. Although we see residential investment has been slowly picking up in the third quarter, we have been experiencing a decline in both residential and non-residential investments. Here I would like to point out the building permit issuance for new single-family homes as a good indicator of the residential investment slight increase. Overall, government purchases appear to be rising, even though the federal defense spending decelerated, and the nominal U.S. international trade deficit remained about unchanged, but we do see some changes in net exports. Isn't that right, Sebastian?
Yeah, that's right. We can see changes in net exports. Which is another component of GDP. So we see that it has been increasing at a rate of about 4%. However, we can also notice that it's going the same direction as the exchange rate index, which is a measure of the US dollars compared to other major currencies. It's a little bit strange because we would expect the exchange rate to go the opposite direction as net exports, but it may be because of tariffs. Has this have any effect on the labor market, Joe?
Well, our unemployment rates remain consistently below the natural rate of unemployment rate for some years now. We've dropped even further from 3.7 to 3.5%. Even with our U6 rate well above that, is dropped from 7.2 to 6.9%. Our civilian labor force participation rate for ages 25 to 55 has remained steady at 63.2% without much change. Initial claims to unemployment insurance has dropped about 1.4%. If we expected an immediate drop in the economy in the near future, this is the first thing we'd expect to see. But after that, average hourly earnings for all employees has risen 2.9%. And to move over to capital utilization, this rate's at about 77.4% and remains fairly steady. So our labor markets indicate that our mandate's being fulfilled currently. And then Sebastian, how have our prices been?
Yeah, that's right. One of our goals is inflation. We need to make sure that it's not too high or not too low, which is around 2%. This is our target. So we can look at the PCE, which is the Personal Consumption Expenditure Index. We have the headline and the core. The headline is for all of the goods and services, and the core is excluding the price of food and energy. We see that both of them are positive, but they are relatively low. We can also look at the Producer Price Index, which is negative. So it shows the evolution of the prices for the domestic producers in the US, and it is negative. So these two graphs show that we are below our inflation target. What can you tell us about the federal funds rate, Ben?
Thanks, Sebastian. Given our meeting this past September, we decided to cut interest rates by 25 basis points. So what that means is currently the federal funds rate is sitting at somewhere between 1.8 and 1.9%. down from an average of 2.04% last month. Based on the federal funds rate, we can similarly look at the US prime lending rate. After we decided to cut the interest rate last meeting, the prime rate fell to 5%. Given sluggish business investment this past half year, we ought to consider further cutting interest rates to lower the prime rate and spur business investment in the future. Now let's consider Treasury yields. For the first time since 2007, the spread between 10-year and 2-year Treasury yields became slightly negative in August. Shortly thereafter, however, yields rebounded and continued to do so into October. If we look at the spread between 3-month and 10-year Treasury yields, they became negative for the first time in May since the financial crisis, and continue to stay negative since earlier this month when they started to rebound. The inversion that we see in the yield curve must be taken into consideration because it can pose a risk to the economy. Now let's consider what happened to the repo market back in September. With tax season being one possible factor, the overnight repo rate shot up to 10% from its normal 2%. A shortage of cash was clearly evident, so the desk conducted $75 billion in repo agreements to lessen the crisis. Furthermore, to ensure a crisis like this does not happen in the future, we agreed to purchase $60 billion in Treasury bills to ensure liquidity in the market. So the implication behind this crisis is that the Federal Reserve has once again been expanding its balance sheet. It has been doing so since the Great Recession. However, in October of 2017, it decided to pursue a normalization program that would begin to unwind the balance sheet. And now I'll hand it off to Sebastian, who will mention consumer confidence.
So we know that monetary policy has a lag between the time we apply it and it has an effect on the economy. So we need to look at leading indicators such as consumer confidence. So this is a survey that shows us what consumers think is going to happen in the future, and we say that it is negative and it is decreasing. So it shows that people do not have a great confidence into the future of the US economy. We also see that the new private housing permits have been decreasing, which also shows that people are not confident in the future of the economy. So what can you tell us, Joe, for the policy recommendations?
Well, our labor market gives us no reason to make any changes to monetary policy. However, Simon, I feel that you concur with me on the developments of this.
Yeah, sure. The economy is doing quite well at the moment, and consumption is a big part of it. In order to keep it this way, I would encourage slight monetary easing delivered in a way of decreased interest rates. Ben, what do you think?
I believe it is absolutely imperative that we lower the interest rate given soft investment in businesses and the need to lower the prime lending rate. And if we look at the recent inversion in the yield curve, that can pose a threat to the economy. And if we see what happened with the repo market last month, that also can potentially be a weakness in the economy, which would make it necessary to lower interest rates. And I would also like to add that we should lower the interest on excess reserves to further encourage liquidity in the repo market.
To follow up on that, we also need to look at the global economy, and we see that the Eurozone is experiencing a downturn because of a slowdown in the manufacturing sector. We also noticed that China and India's economy are also slowing down, and there is also a lot of tension in the Middle East. And we also need to note that there is softness recorded in the capital formation, manufacturing and export in American firms, which might negatively impact hiring decisions, leading to a deterioration of household income and spending.
Consistent with our statutory mandate, this committee seeks to nurture stable prices and full employment. Based on some recent developments, we've decided to drop interest rates from 2.25% to 1.75 to 1.5%, and decrease the interest rates given on excess reserves from 1.8% to 1.5%. Thank you very much, and we are now open for questions.
Good.